1 million Americans are falling behind on their mortgages right now. The quarterly jump in serious delinquency just reported is the largest single increase the Mortgage Bankers Association has recorded in 47 years of tracking this data. Not since 2008, not since COVID, in 47 years. The FHA delinquency rate just hit 11.52%. To find a number that high, you have to go back to 2011, the absolute floor of the post-financial crisis wreckage. And yet here we are in 2026 with the Fed having cut rates 6 times, home prices supposedly still elevated, and the economy supposedly still holding, and we just printed a delinquency number that belongs in a recession. Here's why this matters whether you have an FHA loan or not. If you're a homeowner, when foreclosures start hitting your zip code, your comparable sales disappear and your equity moves with your neighbor's equity. If you're a buyer, the FHA crisis is a map. It tells you exactly where neighborhoods are about to see distressed inventory. If you're a seller, the window you think you have may be shorter than your agent is telling you. The delinquency pipeline leads foreclosures by 12 to 18 months, and that pipeline is full right now. 3 things need to be understood. First, the specific states and zip codes getting hit hardest, because this crisis is not where the national headlines are pointing. Second, 43,000 veterans were promised a government lifeline, watched it get canceled with almost no media coverage, and now have no options, no loss mitigation, and no path forward. And third, the FHA delinquency rate isn't the crisis, it's the warning signal. What happens to FHA borrowers today historically reaches conventional borrowers in 12 to 18 months. That clock is already running. The FHA crisis doesn't exist in a vacuum. The NAR reported existing home sales in January at 3.91 million annualized, down 8.4% in a single month, the sharpest drop in nearly 4 years. Pending home sales came in at 70.9, the lowest reading in the entire history of that index going back to 2010. Homes are sitting on the market for 62 to 66 days compared to 36 days 4 years ago. Here's a comparison that reframes everything. Pending home sales right now are 20% below where they were in January 2011, in the middle of the housing crisis aftermath. We have worse forward-looking demand today than during the Great Recession recovery. The Fed cut rates 6 times, 175 basis points worth. Mortgage rates barely moved, and buyer demand kept falling anyway. That is not a rates problem. That is a structural problem. And that is the market FHA borrowers are falling behind in. The national FHA delinquency rate stands at 11.52% as of Q4 2025. The spread between FHA and conventional borrowers just blew out to 841 basis points. FHA borrowers are defaulting at roughly 4 times the rate of conventional borrowers. HUD's own January 2026 loan performance data shows 13.7% of all FHA loans are past due. That is not an outside analyst's estimate. That is the government's number about its own program. At the state level, Louisiana has 8.6% of FHA loans non-current, Mississippi 8.4%, Alabama 6.4%, Indiana 6%. In Louisiana, roughly 1 in 12 FHA borrowers is behind on their mortgage right now. These are not markets making national housing headlines, which is exactly why this is being missed. At the city level, Memphis, Birmingham, Detroit, and Cleveland are mid-sized markets where FHA loans represent 30 to 40% of all outstanding mortgages. When delinquency runs at 11% in a market where 4 in 10 loans are FHA, the neighborhood level damage is not marginal, it's structural. At the zip code level, specific areas in North Philadelphia, Milwaukee's 53206, and Gary, Indiana have FHA serious delinquency rates above 25%. 1 in 4 FHA borrowers on those specific streets is 90 or more days past due. The geographic data tells you where. But the profile of who is actually behind these numbers is what makes this crisis so significant. These borrowers bought between 2022 and 2024 with an FHA loan and 3.5% down. Purchase price between $280,000 and $380,000, the exact range where FHA volume was highest at the peak. household income around $70,000 to $85,000, monthly mortgage payment between $2,100 and $2,400. Here's what their lender didn't model into the approval. Florida homeowners insurance now averages $7,136 a year, 181% above the national average. 7 major carriers have stopped writing new policies, restricted coverage, or stopped renewing existing ones. California's insurer of last resort has exploded to $724 billion in total exposure, up 230% since 2022. An Insurance.com survey found 47% of California buyers and sellers ran into insurance problems in 2025, with 21% seeing deals fall through entirely. Escrow payments in Florida, covering insurance and property taxes, have increased 70% since 2019 and now represent 38% of the total monthly mortgage payment. A homeowner who locked in a 3% rate in 2021 can still face payment shocks severe enough to trigger delinquency, not because their rate changed, but because the costs wrapped around the mortgage became unmanageable. Property taxes reassessed 15 to 20% higher. HOA fees up 30%. According to Totality's 2025 analysis, non-mortgage ownership costs jumped 30% in a single year, with total monthly housing costs running $600 to $900 higher than the day these buyers closed on the same income. They didn't lose their job. They didn't make a reckless decision. They did exactly what they were told homeownership looked like. The math simply stopped working. Then the February jobs report hit on March 6. The economy lost 92,000 jobs against an expected gain of 60,000, one of the largest forecast errors in recent memory. Unemployment rose to 4.4%, the third payroll decline in 5 months. For a conventional borrower with strong equity, that number is concerning. For an FHA borrower already spending 38% of income on housing costs from insurance and taxes still rising, that number is the difference between hanging on and letting go. The VA Servicing Purchase Program, VSP, was designed precisely for moments like this. Veterans who had fallen behind on their mortgage could have their loans restructured down to 2.5% fixed rates. It worked. Between its launch in May 2025, it helped approximately 35,000 veterans avoid foreclosure. Then in May 2025, with almost no press coverage and no replacement program announced, it was canceled. The result: 43,000 veterans sitting 6 or more months delinquent right now have no effective loss mitigation option, not a modified option, not a reduced option, nothing. VA foreclosure inventory just hit 0.84%, the highest level since 2019. The MBA's own characterization of the quarterly jump in VA foreclosure inventory, the largest quarterly change recorded since the inception of their survey in 1979. That is 47 years, the largest ever recorded, and 43,000 veterans with no program, no path, and foreclosure rate climbing at a pace this country hasn't seen in 5 decades. FHA delinquency is not just a metric, it has been a leading indicator for 20 years. In 2006 and early 2007, FHA delinquency started climbing in specific markets while conventional loan performance still looked healthy. Mainstream analysts called it contained and isolated. By 2008, the conventional market had followed FHA into crisis, running approximately 18 months behind. Today, FHA serious delinquency is rising at the fastest quarterly pace in 47 years. Conventional delinquency remains relatively contained at 2.58%. That gap is not reassurance. Based on the historical pattern, it is a 12 to 18-month warning. The mechanism is straightforward. Distressed FHA sales hit a zip code and pull down comparable values. Lower comps reduce equity for every homeowner on that street, including conventional borrowers. Some tip from equity positive to underwater. Underwater conventional borrowers facing a job loss, divorce, or medical event cannot sell without a short sale. Short sales and foreclosures accelerate comp erosion. The cycle tightens. In zip codes where FHA delinquency currently exceeds 15%, Home values are declining at 2 to 3 times the rate of surrounding areas. That is current data, not a projection. For those in the Northeast and Midwest thinking this doesn't apply to them, Chicago Case-Shiller is up 5.7%, New York up 5%. Hartford was just named the hottest market for 2026. Consider what's underneath those numbers. These markets are appreciating while losing population. New York lost 137,000 net domestic migrants in 2025 while prices rose 5%. That math requires an ever-shrinking pool of buyers paying ever higher prices. It works until it doesn't. Austin is 27.8% below its 2022 peak. Hartford is 21.2% above it. Those two lines are moving toward each other. The Northeast and Midwest are not immune. They are delayed. There is a significant and costly difference between those two things. The median age of a first-time home buyer just hit 40, an all-time record. The share of purchases by first-time buyers dropped to 21% against a historical norm of 40%. The people most dependent on FHA financing are being priced and defaulted out of the market simultaneously. The job market is cracking beneath them. The Fed is sitting on its hands because inflation remains elevated. Mortgage rates are stuck at 6% despite 175 basis points of cuts. Fed Chairman Jerome Powell told Congress in February, in a statement that received almost no coverage, that in 10 to 15 years there will be regions of the United States where you could not get a mortgage because no insurer will cover the home. That is not a fringe prediction. That is the Fed chairman describing the logical endpoint of what the insurance data is already showing. First Street Foundation estimates 39 million U.S. homes are currently insured at prices that don't reflect their actual risk. When those prices reset, and they will, the payment shock currently hitting FHA borrowers in Florida and California becomes a national story. The entry point into homeownership is not just expensive for a generation of Americans. It is structurally disappearing, squeezed from every direction at once by insurance costs, property taxes, mortgage rates, job losses, and a government program for veterans that was there one day and gone the next.